Hi, I'm Ray Wateska with West Shore Mortgage and Investments Company in Tampa, Florida. And today's topic is, what is a hard money loan? But before I get into that, subscribe to my channel and click the bell icon to be notified whenever a new video is uploaded. So getting back to hard money loans regarding real estate, a hard money loan is basically an equity position in the property. It's typically 50 to 65% of the appraised value of the property. That gives the lender or investor a secure position in the property if in fact there's a foreclosure or default on the property. It's traditionally, the recovery rate is about 60 to 65 cents on the dollar through foreclosure, sale, or forced sale. For example, if we had a $100,000 property, we would loan $50,000 to $65,000 as a good equity position. So that's 50 to 65% in that scenario. With regards to the rates and terms for hard money loans, they're typically higher than traditional or portfolio loans. They're not cheap, but they require little qualification, and you can typically close pretty fast, probably in about 3 to 7 days, depending on how fast title and appraisal comes back. Now, one thing that is very common in the calls that I get is there's a misconception with regard to a hard money loan. People seem to think that while you don't have to qualify, or there's little qualification, that you don't have to have any money for the transaction. And that's untrue in most cases. Let's take that example of $100,000 once again. If you're buying that property for $100,000 and I'm lending you $50,000 to $65,000, you need to have the difference, the other 35 to 50%. That would be $35,000 to $50,000 plus closing costs and reserves in this situation. So you've got to be working with money if you're doing a hard money loan. Conversely, if you're refinancing and you have equity in that property and there's nothing owed on that property, we would be able to do a hard money loan without any cash out of your pocket other than paying for the appraisal up front and sometimes a site inspection. So you would get 50 to 65%. We're normally around 65% loan to value at this point in time. Now, again, there's a misconception that you don't have to have any money, but in some rare instances now in 2020, you can get away with not having much money into a transaction. And it would be in a scenario like this. You're buying an extremely nice property in good condition with good income potential for $250,000, let's say, but the actual value of that property as of today is $500,000. Well, we would loan you the money to buy that property because we'd be at 50% loan to value without much exposure. If you default on the property, there's some money to be made. Typically, even in the best case scenario, you should try to figure of having 10% plus closing costs, which could be from anywhere to 8 to 10% of the purchase price. Also, that scenario will depend on the collateral. Again, the quality of the collateral, what work is required to be done, and how quickly it could be liquidated, the demand. And that's why we like to make loans in highly populated, dense areas of major metropolitan cities and whatnot, because the marketing time is going to be much less and the demand is going to be much higher, so we won't hold on to the property for a long period of time if in fact there's a foreclosure. There's two different types of hard money loans. There's institutional, which would be like a portfolio lender, which are some of our larger investors, and then there's also private investor money. Now, the institutional lenders have taken hard money to another level here recently in the last few years. They'll loan up to 70 and 75% of the current value of purchase price, whichever is less. Typically, you only need to have an appraisal for the property, title, survey, and insurance. But that takes probably just a few days to get that information. The rates and fees are higher than conventional, but it's a lot less than private money. There's typically no prepayment penalty on institutional hard money loans, and they are credit score driven in some cases, however. And the reason for that is because we're trying to ascertain whether or not you're going to be able to perform on your exit strategy. So if you say, Ray, I'm buying this property, I'm going to fix it up, and I'm going to refinance it, well, we're going to have to look at your credit to make sure that it makes sense, that you have the ability and the wherewithal to be able to refinance it when the time comes due. Why I say that is because if you're telling me you're going to refinance that property in a conventional loan and you have a 400 credit score, well, that's not going to happen. In all cases, the best exit strategy with all transactions is really to sell the property. That's going to be the easiest, and again, it's no qualification on your part. Now, the difference between private hard money also is Private hard money, I can be much more flexible. We have some latitude there with our private investors, as we wouldn't with an institution who typically has their requirements written in stone. We can get higher LTV. So for example, if I say we're going to do 50 to 65%, sometimes I can do 70, 75%. And even in extreme cases where there's an extremely experienced borrower with a lot of liquidity in the bank and it's a really nice property in high demand, we could go maybe even a little bit higher, up to 80%. But again, that's a rare occasion. Again, we'd like to know the exit strategy. Hopefully you have a good one where you're going to refinance it or sell it. We see a lot of properties that are being flipped right now. They're making fast profits, getting out and buying another one, maybe holding every fourth or fifth property. The different property types that we loan on are going to be investment properties only. We don't loan on any owner-occupied primary residences at all, but we will loan on single-family residences for rentals. We'll loan on condos and townhouses as well, and then we have commercial loan programs as well. While the LTV might not be as high, we can still do those loans based on an equity position in the property. We like income producing properties that generate rent or other income other than the borrower's own sources. So for example, if the borrower defaults, then we can go collect the rents off of the tenants and be able to service the debt, make the payments on the mortgage, the taxes and insurance when they come due also. With regard to borrowing, the borrowers have to be an entity. That would be an LLC or corporation, and then you as the individual will be the personal guarantor, and that's why we look at your credit score. So, and the reason for that is if you become involved in some kind of personal financial situation like bankruptcy, the bankruptcy would not affect our loan because the property is being held in a corporate name. With regard to timing, again, everything is pretty simple and pretty easy. All I need to do is get some basic information from you. You can easily submit your scenario and get signed up on our newsletter by clicking the link below, entering some basic information, and then you'll automatically be entered into our newsletter list and be getting periodic updates from us regarding the programs that we have, any new closings that we do, and other helpful information for you regarding real estate investing. So you can do that. Again, if you find this video has been helpful for you, please like and share. And also, I would say subscribe to the channel and then hit that bell notification icon so that you can be notified whenever a new video is uploaded. This is Ray Wateska. I look forward to working with you. I hope I can help you get your projects funded. Feel free to reach out to me if you have any questions. Again, submit your information through the link below. Would be the easiest and the fastest.